Big corporate Wall Street landlords are taking huge losses right now in the middle of 2022. These losses are going to cause a major Wall Street fire sale in the US housing market. Redfin just reported a couple days ago that investor home purchases crashed by 17% in the first quarter of 2022. They quoted a realtor in Nashville who said that a few months ago, 95% of homes for sale in Nashville would get at least one cash offer from an investor. But not anymore, folks, because today most homes aren't getting any investor offers. The realtor went on to say that this is good news for regular home buyers. Regular home buyers like you all watching this channel are going to have more inventory and cheaper home prices to choose from. However, you need to note this investor fire sale and crash is going to be most severe in specific cities and neighborhoods around America in 2022 that I'm going to reveal to you later in this video. But first, I need to address a question that I think is already brewing on a lot of your minds. You guys are probably saying to yourselves, wait a minute, all we heard about for the last 6 to 12 months was that investors were taking over the housing market. Why are they now all of a sudden bailing out? What's going on? Well, folks, the answer to this question has everything to do with two main trends that are developing right now in the housing market. Number one is increasing mortgage cost and cost of debt, while number two is declining profitability for landlord rentals. And that second point on declining profitability is a key one that a lot of people don't understand, because if you look at the last 8 years of data on investor cap rates, aka the rental profit that comes from buying and renting out a house, we can see that the cap rate is all the way down to 4.4%, meaning that if a Wall Street investor bought the typical priced home in America of $352,000, they would earn about $16,000 a year in net rental income after deducting expenses. This cap rate and investor return has been on a consistent downward decline over the last 8 years, forcing many investors to accept lower profits in order to buy into the housing market. Now, here's what's interesting. Accepting lower profits made sense for a while because these Wall Street investors could borrow at very cheap costs of debt, especially during the pandemic. You can see if we add the orange line to this graph, 30-year mortgage rate in America, during the pandemic, that cost of debt went down to 2.7%, meaning that even though the profitability of the rental was declining, the cost of debt was declining by more, which meant that there was still an incentive to buy. However, this incentive no longer exists today as the mortgage rate has shot all the way up to 6%, well above the income potential of the property. And this is a huge deal, everyone, because the fact that the mortgage rate now, the cost of debt, is above the rental profit yield, that means that any investor buying into the 2022 housing market with debt is likely losing money after they rent the house out to a tenant and then pay their lender, which is why way fewer investors bought homes in the first quarter of 2022 and why fewer are buying homes this quarter, and why by the end of the year, we're going to see a big real estate investor sell-off, especially in certain cities. Cities where companies like Progress Residential operate. Progress Residential is the largest private landlord in America. They own over 80,000 housing units, and they've been very active in buying up single-family homes during the pandemic and then trying to jack up the rent on prospective tenants. You can see this very clearly on a property that Progress Residential owns in Phoenix. They bought it for $427,000 in early April, paying 200% over the previous sales price. They then listed it at $24.50 a month for rent, a sky-high rental rate for this market. However, they haven't been able to find a renter, and they've been having to cut the rent ever since. And it's likely that Progress Residential is going to need to cut the rent even further on this house in Phoenix in order to attract a tenant, which is going to be an issue because it means that their income yield and their return is going to go even lower, just as Progress Residential's cost of debt and borrowing is surging. Because over the last 12 months, we can see that the interest rate Progress Residential is having to pay on its mortgage-backed security issuances, which it uses to finance these acquisitions, well, the interest rate's gone from a minuscule 2.2% in the summer and fall of 2021 all the way up to 5.3% in June of 2022. So this is the explanation for the data we looked at in the beginning of the video, that 17% slump in investor home buying. It's all related to increasing interest rates and declining profitability. And I believe when Redfin's second quarter investor home buying report comes out, we're going to see an even bigger crash in purchases, which already is dramatically pushing inventory up in certain cities around America and pushing prices down, particularly in a metro like Phoenix, where investors have purchased nearly 30% of all the homes on the market in the last 12 months. I predict home values in Phoenix are going to plummet over the next 6 months as this investor fire sale takes hold, particularly in certain zip codes to the southwest and to the west of the metro, where nearly 50% of all the homes in certain neighborhoods are being purchased by investors. We could see massive pain, 20, 30, even 40% price decline. Another metro that's in the crosshairs is Charlotte, North Carolina. Over 30% of home sales in the last year were to an investor, and amazingly, there's certain zip codes where over 60% of sales were to investors. And in just 1 second, I'm going to reveal even more cities that that investors are going to crash, because you folks need to understand the rental market, not just the for sale housing market, but the rental market in America is a ticking time bomb, because rents across America have surged 3 times faster than wages over the last 12 months, meaning that the renters in these properties owned by Wall Street investors are feeling the squeeze and can't afford the rent that's on their lease. And if you don't believe me, just ask Progress Residential. They're basically telling their investors this. In their most recent mortgage-backed security offering, they revealed that only 87% of their tenants in the first quarter of 2021 paid their rent in the month that it was due. This is down from a historical average of 96%, meaning that Progress Residential is starting to see something called collection loss, rent that they're not collecting, otherwise known as bad debt. This increase in collection loss and bad debt is the first sign of an eviction wave that's going to hit the US rental market. We of course dodged the eviction wave over the last 2 years due to the federal eviction moratorium that prevented over 3 million eviction filings. Well, I don't think we're going to be so lucky this time around. Expect a lot of evictions in the second half of 2022, especially as America heads towards a recession, a combination that could cause the rental housing bubble in America to pop. And if the rental housing bubble in America pops, these Wall Street investors, mark my words, they are heading for the door. They are heading for the exits. They are going to liquidate their properties faster than you can even imagine, which is going to cause, in my opinion, an inventory surge on the US housing market comparable to the one that we saw in 2008 and 2009 when the last housing bubble crashed during the subprime crisis. I think we're going to see investors put 2 to 3 million homes on the market in only a handful of years, which is going to send inventory out of control and cause prices to crash. And I know that prediction is a brazen one, it's a big one, but it starts to make sense when you consider that investors across America, both small investors as well as large Wall Street investors, own nearly 20 million homes right now. Nearly 1/5 of all the single-family homes in America is owned by an investor. What do these investors do, both big and small, when home prices start going down and all of a sudden evictions surge and tenant delinquency surges? You know what they're going to do. They're going to try to sell their house at top dollar before values go down even more. And this crash is going to be most severe, like I said, in metros like Charlotte and Phoenix that have a lot of investor purchases, but also in a place like Atlanta, which is actually the #1 investor buying market in America, particularly in these zip codes to the southwest and west of the metro, where 60% of homes are purchased by investors. And this means it's not enough for you to know just if your city or metro is exposed to this investor crash, but you should also ask, is your neighborhood exposed? Just like we're looking at Atlanta, these areas in orange are super exposed to an investor crash because they have so much investor demand. But meanwhile, if we go north of Atlanta, we can see the zip codes to the northern suburbs are only about 10 to 15% investor purchase share. So it's really important you all understand how many homes investors are buying in your zip code and neighborhood. And luckily, Redfin actually provides that data for free. I'm going to have a link in the description to the Redfin data set so you can see how many homes investors are buying in your neighborhood and market. Now, before signing off, I need to show you all one last graph because it's really important that you understand why investors are buying less homes and are going to continue to buy less homes. And it's not just deteriorating profit and increasing cost of debt. It's also the fact that other investments like the yellow line, the average yield on investment grade corporate bonds in America, that now yields a higher return at 4.7% than the return on buying a single family home and renting it out. This is the first time in the last 8 years this has happened where corporate bonds are yielding more. The reason is because higher interest rates are increasing the return of all types of fixed income investments. And as this happens, real estate is going to become less and less attractive because after all, why would you go through the hassle of buying a house and dealing with finding a tenant and dealing with repairs and evictions if you could just sit on your couch and buy the Charles Schwab 5 to 10 year bond ETF and make as much or more money? Now, one last thing, everyone. This news on the investor purchases and the eventual fire sale that I'm predicting is a big deal in the housing market. And I'm going to be doing lots of videos on this topic going forward, giving you guys updates on how many homes investors are buying and selling and the markets that are crashing first. If you want to see those updates, it's really easy. Just do 2 things. Number 1, smash that like button into oblivion. That's one of the best ways you can support this channel. And then number 2, make sure you're a subscriber with your subscribe notifications turned off. Whoops, I meant on. Turn those subscribe notifications on. This will ensure that you receive email updates every time I post a video.